Realtors, friends, and homebuyers. Let's pull back the curtain and demystify the issue of condominium warrantability for home purchases. I am the digital twin for five-star home loan officer Stephen Ackery. He writes the scripts and does all of the real lending work. I simply make it easier and faster for him to produce the content you need. A condominium home can look completely perfect, yet still have financing problems because lenders evaluate the condominium association and whether it fits the well-established box of lending guidelines for home mortgage loans. Even the most desirable unit may not be financeable on a conventional loan due to the warrantability review status of the subject condo association. One common misconception is that a special assessment automatically makes a condominium non-warrantable. That is not necessarily true. Underwriters want to know why the assessment exists, whether the work is funded, and what the assessment reveals about the association's financial, insurance, and physical condition. Here are 7 condominium association warrantability financing review issues that realtors should identify as early as possible. Number 1, inadequate reserves. For conventional financing, the condominium association's annual budget must allocate at least 10% of its budgeted gross revenue to reserves. When the reserve contribution is below 10%, that does not automatically mean the association is non-warrantable. However, it does require additional information and research make a determination as to whether this could become an obstacle to your buyer obtaining financing for that particular condominium unit. The lender may need to review the association's reserve study, if any, why current reserve balances, anticipated capital expenses, and overall financial condition. If a unit has been recently purchased with conventional financing in the project, that is a good sign for your current buyer. However, realtors should never assume that a condominium is financeable simply because another unit in the same project recently sold with financing. Number 2, warrantability risk. Unrepaired storm damage or pending insurance claims. This is especially important in Florida. A condominium project may have hurricane, wind, water, roof, or exterior damage that has not yet been fully repaired. The association may also be waiting for an insurance settlement, negotiating with the carrier, or involved in a disputed claim. On this type of question, just rip the Band-Aid off quickly to avoid the torture of wasted time and energy on a deal that will fall apart faster than Neo dodges bullets in the Matrix. The lender will need access to the insurance agent and to understand the extent of the damage, whether the building remains safe and fully usable, whether repairs are funded, and when the work is expected to be completed. An unresolved insurance claim combined with unrepaired damage can make financing much more difficult and may cause the association to fail a warrantability review. Third risk for warrantability: excessive rental concentration. If too many units are investor-owned or rented, the condominium project may not meet conventional financing guidelines. Rental concentration matters most when the buyer plans to use the condo unit as a rental or investment property. If rental concentration causes the project to be non-warrantable, typically non-warrantable financing will still be available so long as the buyer qualifies based on assets, down payment, reserves, income, and credit. The rental concentration violates conventional guidelines when 51% or more of the units are rentals instead of primary residences or second homes. In considering an offer or listing a condo unit for sale, realtors should ask how many units are owner-occupied, second homes, or rentals to assemble the facts that determine whether the condominium will qualify for conventional financing. Warrantability risk. Number 4, insurance problems. Insurance for the condo association is always evaluated, and high deductibles or unusual master policy coverages that do not meet lending guidelines can often cause a condominium association to be non-warrantable. Evaluating the association's insurance is where your lender comes in. As soon as possible after the purchase contract has been signed by the parties, provide the lender with the contact information for both the condominium association manager and the insurance agent responsible for the association's master insurance policy. The lender may need to review policy limits, deductibles, wind and hurricane coverage, exclusions, replacement cost coverage, and other policy provisions before determining whether the project meets financing guidelines. To save premium costs, many condo associations have increased their deductibles to levels that exceed lending guidelines. So, how do you find out if the association thought they were dodging a bullet by lowering their insurance costs, only to learn that they unknowingly jumped directly into the path of an oncoming train in the form of decreased marketability of their units due to the lack of ability to obtain conventional financing for buyers? For listing agents, this is something worth investigating before placing the property on the market. Knowing whether the association's master insurance policy may create financing concerns allows you to properly advise buyers, agents, and prospective buyers and provide useful information in the MLS condo warrantability risk issue. Number 5, active or pending special assessments. An assessment for routine painting, landscaping, roofing, paving, or another properly funded project may be acceptable. The larger concern is an assessment connected to major repairs, storm damage, insurance shortfalls, deferred maintenance, or work that has not yet been funded, scheduled, or started. The lender will evaluate the purpose of the assessment, the total amount, the amount owed by the individual unit, the payment structure, the status of the work, and what the assessment reveals about the overall condition of the project. We can always ask and get the facts, right? Warrantability risk number 6, litigation and delinquent HOA dues. Not every lawsuit disqualifies a condominium association under financing warrantability review. However, litigation involving construction defects, insurance disputes, major financial exposure, or significant association operations can affect whether the project qualifies for financing. High delinquency rates among unit owners are also a warning sign. When too many owners are behind on their association dues, it may indicate financial instability and increase the likelihood of future assessments or budget shortfalls. At certain levels, delinquency levels of the unit owners can make a condo association non-warrantable. Number 7, structural safety or deferred maintenance concerns. These are often the most serious issues, even though they may not be the first problem discovered. Closest attention should be paid to this item for mid-rise and high-rise condominium buildings. The risk is less for garden-style condos of 4 stories or less. Concerns involving foundations, also balconies, concrete deterioration, roofs, or load-bearing components can prevent conventional financing and, in some cases, prevent the project from qualifying for almost any type of financing. Engineer reports referring to unsafe conditions, significant deferred maintenance, structural deficiencies, or critical repairs require immediate review. So, before a homebuyer submits an offer to buy a condominium unit or condo home, let's ask these questions. Does the association allocate at least 10% of its budgeted gross revenue to reserves? Is there any unrepaired storm damage or a pending insurance claim? What percentage of the units are rented or investor-owned? Does the association have adequate master insurance coverage? Have they increased their deductibles too much for warrantability? Are there any current or pending special assessments? Is the association involved in litigation? And how many unit owners are delinquent on their dues? And are there any structural, safety, or deferred maintenance concerns? The earlier these issues are identified, the more options your buyer may have. Call or text me for a free cheat sheet in PDF for condo warrantability. No cost, no obligation. I will send the PDF directly to you via text. Bonus advisory for realtors. What to do if the condo association is non-warrantable, but your buyer still wants to buy a unit in that project? Does your buyer qualify for this type of loan? A small portion of buyers may still be able to qualify for financing in a non-warrantable condominium project. if they meet the requirements of a non-warrantable condominium loan program. These underwriting criteria are tougher than a standard conventional home mortgage loan. Certain problems may prevent an association from qualifying for almost any type of financing. Structural foundation problems, unresolved material litigation, or serious unresolved safety concerns would be common examples. However, many of the issues that cause an association to fail a conventional warrantability review may still leave the project eligible for financing under a non-warrantable condominium loan program. Every situation is different. As a trusted lender, we guide you and your buyers every step of the way. The best course of action is to first determine exactly why the association is non-warrantable. Then the buyer can apply and determine whether they are still able to purchase the unit using a non-warrantable condominium loan. In general, a large percentage of typical buyers will not qualify for this type of financing. The buyers most likely to qualify for non-warrantable condo purchase loans are generally those with a large down payment, substantial liquid savings, significant retirement assets, strong income, and a high credit score. I'm Stephen Ackery, 5-star home loan officer. We are actively providing home mortgage loans for condominium homes nationwide, all nifty 50 states. We assist realtors and home buyers to evaluate their condo associations. Put my team to work for you early so we arrive at Krispy Kreme just as the hot and fresh donuts are coming off the production line, and before Homer arrives to fight you for them. I can help you determine the warrantability of the condominium association, identify the available financing options, and evaluate whether your buyer may still qualify even when the project is non-warrantable. Bumps in the road can be smoothed and you can still have a pleasant ride to your successful closing. Asking the right questions and completing the follow-up is similar to hot and fresh, worth every bit of effort. Just remember to hustle up and get out of there before Homer Simpson catches up with you. Nobody wants to tangle with Homer when he has a hankering for a hot donut, right? Right? Text me, 9415-247-897, to put my team to work for you for the warrantability review for your next condo deal and your next homebuyer pre-approval. We consult with realtors and homebuyers on weekdays and evenings and on weekends. Remember to like, follow, and subscribe for more content like this. Your support makes it possible for us to produce more content. Thank you for watching.